Today's session delivered a mix of conflicting signals. The 10-year Treasury yield dropped sharply, falling over 1% intraday, while the S&P 500 and QQQ both showed decent rebound strength after earlier weakness. This divergence between bond yields and equity price action is becoming one of the most important drivers of market behavior right now. At the same time, investors are interpreting fresh inflation data as a sign that the Federal Reserve might eventually ease policy, yet risk sentiment remains fragile. In this breakdown, we'll walk through what today's move in the 10-year yield means, why SPY and QQQ behaved the way they did, and how this could shape the near-term market context. Let's dive in.
Starting with the most critical macro signal, the 10-year Treasury yield. Today, we saw yields move significantly lower, dipping toward 4.05%, which matches a broader bond market rally driven by cooler inflation expectations. Lower yields usually imply lower costs for borrowing, increased demand for fixed income, and a tolerance for riskier assets like growth stocks. But the context matters. The recent CPI report showed inflation running slightly below expectations, prompting markets to price in a higher chance of rate cuts later this year. This is why the bond market is rallying. Investors see inflation easing and assume the Fed will be less restrictive over time. However, note that this is expectation-driven, not yet a confirmed outlook. Yields are leading stocks. That discrepancy is important and will ripple through risk markets.
Now let's look at SPY. From your screenshot, the S&P 500 ended the session with modest gains after earlier weakness. This type of price action, down sharply early, then bouncing, is typical when markets initially react to negative data but then reverse as sentiment improves. What's telling is that SPY's rebound remains shallow and range-bound. It's not a clean breakout nor a confident rally. This suggests two things. One, some profit-taking or de-risking occurred earlier in the session. Two, bulls stepped in as bond yields fell, supporting equities at key levels. This is consolidation, not breakout behavior. The S&P's ability to stabilize near support but not drive decisively higher suggests cautious positioning and ongoing uncertainty rather than conviction buying. Lastly, we turn to Nasdaq, represented here by QQQ. Today, QQQ also closed higher, snapping back after early losses. But similar to SPY, the bounce lacked momentum beyond intraday resistance. Tech has been especially sensitive to rate expectations and valuation concerns, partly because heavy growth names discount future earnings more aggressively. Another theme driving tech volatility and equity weakness overall are fears around artificial intelligence and disruption narratives that have weighed on risk sentiment. Even though today's CPI data and falling yields generally favor growth stocks, tech isn't turning higher with conviction. This disconnect suggests investors are weighing multiple conflicting impulses. On one hand, falling yields make future earnings more valuable. On the other hand, macro uncertainty and sector-specific fears like AI impact and profit pressures are keeping positioning cautious. This environment is typical of a range-bound market that has not yet found a directional catalyst. To sum up, the 10-year Treasury yield fell significantly today, signaling that markets may be pricing in a slower inflation environment and a likelihood of future rate cuts. SPY and QQQ both rebounded from earlier weakness but lack strong follow-through or breakout momentum. Markets remain sensitive to macro data, inflation reports, and sector-specific concerns like tech valuation and AI disruption. This combination, falling yields and hesitant equities, paints a picture of evaluative consolidation, not aggressive risk-on behavior.
For the next few sessions, the key variables to monitor are whether yields continue to trend lower and how stocks respond to fresh macro prints like jobs data and future CPI releases. These drivers will likely determine whether this consolidation evolves into a sustained rally or fresh volatility.